Welcome back, guys, and in this video we're going to be talking about risk management. Thank God we're getting closer to the end of the course. So we've discussed technical analysis. We know what technical analysis is all about. Technical analysis is just basically the act of predicting where price is going to go in the nearest future, maybe up, down, sideways, and so on. I know many traders usually underestimate the importance of risk management, and that's why they lose money in the market. Even though they are very good with technical analysis, they know where price is going to go, but at the end of the day, they still don't make enough money in the market. They still end up losing their money in the market, even though they have good technical analysis skills, right? So what they are lacking is risk management. So for example, you know price is going to go up. How much are you going to put on that trade, right? How much are you going to risk on that trade? If the trade doesn't go right, how much are you going to lose? That's what risk management does. And there are several aspects of risk management we are going to be discussing: position sizing, stop loss, and so on. Without no further delay, let's get into it. So the first one we're going to be talking about is stop loss. Stop loss is a very important factor when trading. Any trade you are going to take in the market must have a stop loss. It is very important. It protects a trader from losing all his money in the market or giving away money back to the market. So a stop loss is an order to close a position at a certain price point or percentage to limit a trader's losses. Are you getting it? So it's an order to close a particular position in the market if you are wrong. So when you are wrong in the market, you don't want to be staying in that position for a long period of time because you can get liquidated. So in margin trading, there's liquidation, which means they will take all your money from your account. It's a stop loss that will help limit your losses in the market. For every trade, you must know your stop loss before entering a particular trade. And the primary purpose of stop loss is to protect your account from getting liquidated when you are wrong on a trade. Do you get that? The primary purpose of a stop loss is to protect your account when you are wrong. And by limiting the amount a trader loses if they are wrong, they are able to continue trading and be profitable without having to win every time. You can be the best technical analyst in the world. You can win 7 out of 10 trades. Do you understand? And still lose money in the market, because every time you win small, and every time you lose big. Imagine out of your 7 trades, you win $20 dollars per trade, and then the 3 times that you lost out of the 10 times, you lost $100. That's huge. You're still going to end up losing money, even though you've predicted right 7 times out of 10. Do you understand? So where are we going to be putting our stop loss? Where should stop loss be? Some traders believe stop loss should be a fixed percentage, but that is really wrong. That is a very wrong perception about stop loss. So let me give you a scenario of what stop loss is. Stop loss is a price level. Stop loss is a point at which a trader's idea for entering a trade has been disapproved by the market. Do you understand that? I'm not really a fan of soccer, but let's use Arsenal and Madrid, for example. So I'm an Arsenal fan. Arsenal and Madrid are going to be playing this evening. So I already put my money on the line and I said Arsenal is going to win the match, right? So at what point will I say, man, this match is not going well for Arsenal? Arsenal is most likely going to lose this match. So let me remove my money from that bet, right? So let's say first half, Madrid scored 1 goal around maybe 20 minutes into the game. At that point, I'm still believing that Arsenal can still equalize. Arsenal can still score 3 goals and then the game will end at 3-1. Do you get me? But at the end of first half, Real Madrid scored another goal. So now 2-0. I'm still believing. So this is now the beginning of second half, right? I'm still believing that Arsenal might be able to equalize. So at what point will I say Arsenal can make this game? again. So let's say we are now at 75 minutes into the game, so remaining just 15 minutes for the game to end, right? So we are now at 75 minutes and Arsenal is still down with 2 goals. So at 75 minutes, I'm already thinking, man, I'm going to leave this game. I'm not going to watch the game again because Arsenal will most likely not equalize and win this game. So at that 75 minutes is where your stop loss is going to be, because that's the point you believe that your idea of Arsenal winning is already disapproved by the game. So you don't believe Arsenal is going to equalize those 2 goals in the next 15 minutes before the game ends. Do you understand? That's where your stop loss is going to be. So a trader's stop loss must be placed at invalidation level. That is to say, the point at which the trader's idea of entering the trade has been invalidated or disapproved by the market. So when entering a trader's hopefully has a thesis for taking that trade. He has a reason for taking that trade. So when that reason has been disapproved, when that reason is no more there, that is where your stop loss, that is where a trader's stop loss should be. So for example, let's say in an uptrend, let's get into the chart. We know that an uptrend is basically a trend forming higher lows and higher highs, right? I know you remember the lesson on trends. So we know that for an uptrend, you keep having higher lows, higher high, higher lows, higher high, higher lows, higher high. But at what point in time would you say this is no more an uptrend? That point is where your stop loss should be. Are you getting it? So at what point we will say this is no more an uptrend, this is a downtrend? And the only time we are going to say that is when we start having lower highs and lower lows, right? So when we start forming lower highs and lower lows, so that's the point you say this is no more an uptrend, this is most likely going to be a downtrend. That is where you should put your stop loss. So in an uptrend, so let's say this is support and you're expecting that the price will come down here, form higher low, and then go up. But what happened? It didn't form higher low. It broke the support where it was supposed to what? Where it was supposed to bounce. So at that point, what used to be support is now resistance. So where should your stop loss be? Your stop loss should be when we start breaking below this higher low that we formed in this uptrend. So this is the last higher low. When price starts to break below this higher low that we formed here, right? Because on a normal day, if it's an uptrend, we're supposed to form another higher low here and go up. But price did not bounce at this support. What happened to the price? It broke the support, retested it, and started coming down. So this point, we already know that we have high here and we have lower high here. That means a downtrend is already forming. So in that kind of trade, you want to put your stop loss below this higher low that formed during the uptrend. So once price is getting to this region, so it means that your thesis about the uptrend is already invalidated because we are already forming lower highs and lower lows. Do you understand? So it is a point where there's a break in market structure where you have been seeing higher lows and higher high, and then there's a stoppage of that flow, and then you start to see lower high and lower lows. So that's where you want to place your stop loss. So for example, in a live chart, so let's look for a trade now. So this area is a resistance, right? And right now we are in a downtrend, right? We are forming lower highs, lower highs, lower highs. So we expect another lower high to form, and then it keeps forming, and then price keeps going down. So let's imagine you took a trade, you took a short trade. A short trade means if the price goes down, you are going to make money. So let's say you took the trade around here, right? Took the trade around here, you're targeting about 8.5%. Where should your stop loss be? So at what point will you say this is no more a downtrend, we are about to start a new uptrend? That is the point where the resistance that we used to have turns to support. And for resistance to turn to support, there must be break in market structure. So price must break above it. So anytime price breaks above it and then that resistance turns to support, now that will be the place where you are going to be putting your stop loss. So your stop loss will just be a little above this area, right? So you are going to put your stop loss around here, because you know that when price is already getting to this place, it means this resistance is no more serving as resistance. It will now be serving as support. I hope you understand that. So now we have been having lower highs. As soon as price breaks above this resistance, that's supposed to be a very strong resistance, and then price turns that resistance into support, then that is where you are going to put your stop loss, because at that point in time you will believe this is no more a downtrend but an uptrend. Do you understand? So that's how you set stop loss. You want to pick a point at which you feel the reason why you're entering a trade has been disapproved by the market. Do you understand? So let's look for another example. So this is another example. Let's say you want to enter a trade, and then you have a trend already. You have this low here, right? And then you see that higher low is forming, which signifies an uptrend. So you are taking a long trade. So long trade means if you take it, if price goes up, you make money. So you are targeting maybe like here, that's 60, maybe 66%, right, as your profit target. So where should your stop loss be? Your stop loss should be right below this particular wick here, because you believe that price was supposed to go up. But if price starts to come down, at what point are we going to say, oh, this price is no more going up, this price will most likely keep going down? So this is the point I will say, okay, this trade, if price gets here, this trade won't be an uptrend anymore. So at this point, please help me close my trade and let me take the loss, because if you don't take the loss, the price can keep going down and you keep losing your money until your account is liquidated in the market, until they take all your money. So you must set your stop loss before you enter a trade, right? So you don't have to worry, because you already know that, okay, this is the amount of money I'm going to lose by the time this trade goes wrong, and this is the amount of money I'm going to make if the trade goes right. So you want to know that for sure. So you don't have to worry. You don't have to worry when the market moves really fast, because it is automated. So when you set stop loss, you don't have to be with your system. You don't have to be checking it all the time. You don't have to be checking that position. The exchange will help you close the trade wherever you put your stop loss. Do you understand? Yeah. So a trader's stop loss must be based on technical analysis. I told you that. So it's not fixed percentage. You can't just say, okay, I want to lose 10% of my. No. It is a place where you believe that the reason why you are entering a trade has been invalidated. A trader's stop loss must be placed at invalidation level. I already explained that. When entering a trade, a trader has a thesis for taking a trade. If that reason is no more, then you are wrong, and then you should set a stop loss at that point. So I hope you understand what stop loss is. Stop loss is not fixed percentage. It is a point at which a trader's idea for entering a trade has been disapproved by the market. So your stop loss should be based on technical analysis alone. Do you understand? So let me use this current scenario. Personally, right now, I believe that once the price starts to break above this region, then we are no more in a downtrend. So if I'm taking a trade now, my stop loss will just be right above this region, right above this wick. That's where my stop loss will be. Do you understand? Because if we're in a downtrend and we break above this region and turn this resistance to support, then we are no more in a downtrend, because there's already a break in market structure, and we are no more forming lower highs and lower lows. Now we are forming higher low and higher highs. Do you understand?